That. Thank you.
Thanks, guys. So real quick, I'll just make this really brief. Chanel wanted me to talk about the top 10 mistakes people make with their self-directed IRAs. And there are some mistakes because a lot of people aren't familiar with using a self-directed IRA, so you run into a few of these mistakes. The number one mistake I see people is just not starting soon enough. So if you know you want to use your IRA to invest in private assets or real estate, you want to get the IRA set up. But more importantly, you want to start the movement of money over. Because it's the only thing that's out of our control is how long it takes Fidelity or Charles Schwab to send the money over to Quest. Do you think those guys are in a rush to send your money out when they know they're not going to make any more money on you? No, of course. So a lot of the times the process in moving the money takes the longest out of everything that happens, and it's the only thing that we cannot control. So I've seen people actually lose deals because they didn't start soon enough. They didn't get the account set up and plan ahead and move the money over. Number two, the biggest one of the mistakes people make is just believing the misconceptions. A lot of financial advisors will give you misconceptions and tell you that, oh, you should never invest your IRA into real estate. You'll have to pay all these taxes and do all this stuff. They'll give you all these scare tactics that are just not true. But the main thing to realize that a self-directed IRA is just another IRA. You're just choosing your own investments and you're investing in private investments. A lot of people will tell you you need an LLC to do this. No, you do not need an LLC. It's not a requirement to use your IRA to buy real estate that you have an LLC. What's the reason that we use an LLC with our personal investments? It's for asset protection, right? We don't want to be liable for the investments that we make. Well, the thing about an IRA is the IRA already has asset protection. It's a trust. You're not liable for anything that happens in the IRA because it's the IRA's property. Okay, so you don't need an LLC wrapped around the IRA. It doesn't give you any more added asset protection. So a lot of people have that misconception. And that using an IRA to buy real estate is going to create all this taxation. Okay, when you go to your financial advisor and say, hey, I just found out I can use my IRA to buy real estate, so I'm going to do that, what's he envision you doing? Well, your financial advisor envisions you taking money out of your IRA personally and then going and buying real estate with that money. That's not really what we're doing. That actually would create taxation if you did that. But what you're doing is you're actually moving money over to an IRA that's held at Quest, and when you want to buy real estate with it, you instruct us to buy real estate in your IRA just like you would instruct Fidelity to buy stock with them. So nothing's ever leaving the IRA as a distribution. You're just exchanging an asset of cash for an asset of real estate, and then when you sell it, it goes back to an asset of cash. Okay? So that doesn't create immediate taxation for you. Not understanding the process would be the third mistake I see people make. You know, knowing what forms are needed. Yeah, we need some forms to process investments, so understanding the forms that we need to process an investment is important. Understanding the difference between checks and wires. We're obviously governed like a bank, so we have to follow banking regulations with checks and wires. If somebody sends us a check to move money over, there's a mandatory 5-day hold. That is not our rule. We have to do that because that's the law. We have to have mandatory 5-day holds on checks. So if you're in a rush for an investment, pay the extra 20 bucks and get the wire over, right? So understanding the process with that. Understanding the overall time frame. So anything that we have to do takes 24 to 48 hours. Anything somebody else has to do, we don't know what that time frame is. So that goes back to moving money over. We don't know how long it's going to take your credit union to move your money over. We don't know how long it's going to take Oppenheimer to move your funds over. But once the money's over at Quest and we need to do something for you, it's 24 to 48 hours. But it's important to understand the forms that we need so we can move forward in your investments. Okay, so number 4 is when you're using your IRA to buy real estate or other private investments, it's important to know that the vesting that you use. Because remember, when you're drawing up a purchase contract or signing for things or drawing up contracts for whatever you're buying, you're not buying as you. You're buying as your IRA. So when you're drawing up the contracts, which is one of the steps that you do as the fiduciary, you need to make sure that you use the proper vesting for your IRA. And an IRA at Quest would simply read Quest IRA Inc., and then it would follow with the letters FBO, which are for the benefit of, and it would follow with your name and IRA account number. So that's the typical way that custodians use as a vesting. And we always run into issues with clients either just rushing through it or forgetting that they're using their IRA, and we get contracts in someone's personal name, and then we have to go back and tell them, well, we got to get this corrected if you want your IRA to buy this because we got to get your IRA's vesting on there correctly. So understanding the proper vesting when you're using your IRA to buy property. Okay? Number 5 is due diligence. So one of the things with the self-directed IRA is, and one of the pitfalls with the self-directed IRA and why it's not for everybody is because at the end of the day, who do you think is the person that you point the finger at if the investment goes bad? Yourself, right? So with the self-directed IRA, the good thing is you get to pick the investments. What the bad thing is with the self-directed IRA is you get to pick the investments. So when you pick the investments, make sure you do a little due diligence. First, make sure you understand the investment. If you don't understand it, get professionals to help you analyze the deal. Okay, there's nothing wrong with getting 2 or 3 people who are familiar with the investment to help you analyze it. Okay, make sure you trust the people you do business with. Now this is tough because obviously there's a lot of snakes out there. And there's a lot of people that will try to take you for your money. And that's why it's important to come to events like this because you get to know people. It's all about networking, right? As you network with people, you realize who are the people that are trustworthy and who are the people that are experienced. You know, be cautious of people that tell you, oh, this is a guaranteed investment, no way to lose, right? Be wary of those people because there are people out there that you cannot trust. And again, it just takes networking to figure out who those people are and who are the people that you can trust. But then verify and cross-check all information provided. Don't go off just what somebody tells you. Don't just go off someone's opinion of how great this deal is. Always get a second or third opinion. I've bought real estate since 2002. There's not a deal that I've ever come across that I've not asked 2 or 3 other people what their opinion of that deal was. Even if I think it's a good deal, I want a couple eyes on that thing to make sure that I'm seeing it right. So verify and cross-check all information, especially when you're in charge of the investment. You want to make sure you're picking a good investment. And again, use professionals to help you analyze your deal, especially if you're new to this. And this is why it's good to come and meet people like Shanoa, meet people like Phil. I mean, these are people that have done thousands of investments. It's good to brainstorm with these people to help them guide you along the way. Not understanding the rules and IRA restrictions. There are restrictions when you're using your IRA. This is something that we teach in our classes. There's certain people that your IRA can't do business with. There's certain transactions that it can't do with those people. And there's certain investment restrictions that you can't do. The people restrictions is just the biggest thing, and I'll just mention that. There are certain people that are called disqualified people to your IRA, and your IRA must be a hands-off or arm's length transaction from these people. The first person that's disqualified is yourself as the IRA owner. So that means you can't self-deal with your IRA, right? If you own a house, you can't sell it to your IRA because you're really working both sides, right? If I was selling a house to my IRA, you think I can finagle the price on that transaction? Sure I could. Okay, so you can't self-deal with your IRA, and the other people that are equally disqualified to you would be your spouse, and then your lineal ascendants and descendants and their spouses, that's parents, grandparents, and kids and grandkids. Okay? The reason why they disqualify those people is that's usually how wealth is passed. Right? They usually pass wealth to the kids and grandkids, so it makes sense that those people should be hands-off from the investment if they're the ones that are going to end up inheriting the investments. So it's important to understand these rules, and again, we don't expect you guys to be IRA experts. Just know the IRA experts. You call us. If something's confusing or you want to do a deal and you're not sure if it quite meets the code, call us and we'll help you analyze that. That's part of the thing that we do. The transaction restrictions are just all the things that the people can't do, and the investment restrictions are just the 2 things I mentioned earlier, life insurance and collectibles. So those are just the 2 things that you can't use an IRA to buy. Number 7, this gets people quite a bit, not accounting for rehab costs. So remember, if your IRA owns the property, and this is a property that you need to fix up, and there's some rehab involved, your IRA must, in most cases, pay for that rehab as well, because remember, your IRA is the owner, okay? Those disqualified people I mentioned, those people are prohibited from paying for anything for the IRA. So if your IRA bought a property, you cannot pay for the rehab. Okay, that's actually that's prohibited. Your wife couldn't pay for the rehab. Neither could you all those other people that I mentioned up and down the line. But family to the side could pay for the rehab. Brothers, sisters, aunts, uncles, cousins, nieces, nephews. So it's important to understand who can pay for things and who can't pay for things. Hard money, sure, yeah, hard money. Hard money can pay for things. You can borrow. There are banks that will loan to IRAs. There's a lot of lenders here, private lenders that will actually loan to IRAs. The different thing with an IRA loan is it has to be what's called a non-recourse loan because it can't be recourse back to you, the IRA owner. It can only be recourse to the property that the IRA is purchasing. But accounting for rehab costs is something that you should always factor in, especially if you're using your IRA, because again, it's not like you can commingle funds. One thing that you could do as a solution, though, is if you know that you need a little bit of IRA money for the purchase and the rehab, and you know you need a little bit of your personal money on the purchase and the rehab, you can start the transaction as a partnership. Okay, like I mentioned before, you can have, I'll just make up a number, it doesn't have to be 50-50, but you can have your IRA put up 50% of the purchase, and then you personally put up 50% of the purchase, which also allows you to partner 50-50 on the rehab. Okay, and it doesn't have to be 50-50, it could be 70-30, but it's important if you know ahead of time that you have to use both buckets, that you start that partnership from the beginning, because you can't use one source of funds to buy it and have the other source of funds rehab it, if that makes sense. Okay. The other thing associated with that is paying the expenses and then asking to get reimbursed. You would be shocked on how many people call us and say, hey, Quest, you know, I've been paying for this, these taxes myself personally for my IRA's own property. Can you guys send me a check to reimburse me? That would be strictly prohibited for us to do that. But worst of all, that would raise a huge red flag to the IRS to say, hey, come look at me. I'm ready for an audit, you know. You guys don't want to put yourself in that position, and we wouldn't want to put yourself in that position. But it's good to know the people that we could reimburse in the event that something like that happened. Again, we can never reimburse a disqualified person, but send us an invoice from a non-disqualified person, and we reimburse them since they paid for it, if you get what I'm saying. Okay? So just understanding that rule. Understanding UBIT and UDFI. Does anybody in here know what UBIT and UDFI is? Vaguely. It is. I am not going to spend time talking about UBIT and UDFI. All I'm going to tell you is that this is taxation that an IRA may have to pay with certain investments. Okay? Now, IRAs are great because a lot of investments grow completely tax-free or tax-deferred, but there's certain investments that will cause taxation, not to you personally, but to the IRA. I'll give you the 3 examples. One is owning a business. If your IRA buys a business, your IRA will have to pay taxes on that profit. Reason being, it's just a leveling of the playing field, okay? If my IRA went out and bought a Pizza Hut and I didn't have to pay taxes, that would be unfair to all the other Pizza Huts, right? I'd have an unfair business advantage. I'd sell all my pizza cheaper and put everybody else out of business. So as a leveling of the playing field, if your IRA invests into a business that's in competition with other businesses, you got to pay a tax called unrelated business income tax. The other one is owning personal property, which is kind of a funny one. The one that will probably get maybe some of you in here is personal property could actually be considered mobile homes because they're not considered real estate if they're not attached to the ground. So mobile homes are considered personal property. Okay? Personal property triggers what's called unrelated business income tax to an IRA. So sometimes it may be one of those investments that's better done outside of an IRA, or one way to bypass it is maybe you loan to somebody who buys the mobile home instead of own the mobile home, because loans don't trigger UBIT. Again, I'm just kind of breezing over stuff. And the thing that we're good at about Quest is if you come to us with a problem, we won't just tell you, no, you can't do it. We'll say, no, you can't do it that way, but here's maybe a way you can do it and get by with it. Okay? UDFI is the third thing that can trigger this taxation to an IRA. And the way that this happens is if your IRA is going to borrow money in order to, or debt leverage an investment, the percent that you debt leverage, you have to split those profits with Uncle Sam. Just give you a quick example. I'm going to buy a $100,000 house. I only have $40,000 in my IRA. Now, I mentioned there's banks out there that will loan you the other $60,000. But in the eyes of the IRA didn't make all 100% of that investment, did it? Right? So it doesn't deserve all 100% tax-free. It just deserves its portion of it tax-free. So if I invest $40,000 and I borrow another $60,000, I'm considered 60% debt leveraged. That means if I get a rent check on that property, 60% of that check I got to split with Uncle Sam. Meaning $400 go, if it's a $1,000 rent check, $400 will go to my IRA free of tax. The other 600 or other 60% I would have to split with Uncle Sam. And it's based on trust rates. Doesn't make it that it's a bad investment because debt leveraging can be very powerful because it'll allow you to buy bigger things. So even though you'd have to pay a tax, don't let it scare you. It should just be something that you're aware of so you're not blindsided by it at the end of the year. And the number one thing that I can't get by without telling you guys is don't ask us for investment advice because we can't. As much as we love talking about investments and as much as we are real estate investors by heart, we can't give you a thumbs up or a thumbs down as to whether or not the investment is a good one. Okay? All we can tell you is whether it fits in an IRA, but that's really legally all we can do. Because once we start giving you investment advice, that puts us on the hook for the investment. and we're not licensed to do that. So, but we're great at it. We love talking about investments. We love talking about different strategies, but please don't come to us and ask me if an investment's good or bad. I'll send you to Chanel and Phil and have them help you guys do that. So that's it. Any questions you guys have?